Before we begin, please remember that I am not a financial advisor, attorney, or housing counselor. This presentation is for informational and educational purposes only and should not be considered legal or financial advice. The information provided is a general overview of mortgage loan modification in the United States. Your personal situation is unique. It is absolutely critical that you consult with a qualified professional, such as a HUD-approved housing counselor or a licensed attorney, before making any decisions regarding your mortgage or your home. Imagine this for a second. You walk to the mailbox and you see it. An envelope with that familiar logo of your mortgage company. But this one feels different. Feels heavier. Your heart starts to pound a little faster because you know what's inside. You've fallen behind. Maybe it was a job loss, a medical emergency, an unexpected divorce, life happened, and suddenly the biggest, most important payment you have is the one you can't make. The late notices turn into default notices. The phone calls become more frequent. You start hearing that terrifying word, foreclosure. It feels like a countdown timer has been slapped onto your life, and the walls of the very home that was supposed to be your sanctuary are starting to close in. You feel powerless, trapped, alone. If that story hits even a little close to home, know this: you are not alone. Not by a long shot. Right now, millions of American homeowners are in this exact same situation, staring at the ceiling at 3 a.m., wondering how they're going to keep a roof over their family's head. They feel like they're in a fight against a giant faceless bank and they're losing. But what if I told you that the bank, the very institution you see as your adversary, doesn't actually want to take your home? Let me repeat that, because it's the most important thing you'll hear today. Your lender does not want to foreclose on your house. Foreclosure is an absolute last resort for them. It's a messy, incredibly expensive, and time-consuming legal process that often results in them losing a staggering amount of money. What your bank really wants is simple: they want to get paid. And they have a powerful, often misunderstood tool at their disposal designed to help you do just that. A tool that can fundamentally restructure your mortgage to make it affordable again. It's called a loan modification. And in this video, we are going to pull back the curtain on this entire process. This isn't just another video with vague tips. This is your definitive guide, your step-by-step masterclass. We will break down exactly what a loan modification is, who qualifies for one, how to build a bulletproof application package, and the critical mistakes you must avoid that could get your application instantly denied. By the time you're done watching, you won't feel powerless anymore. You will be armed with the knowledge, the strategy, and the confidence to take control of your situation and fight to save your home. So, what exactly is a mortgage loan modification? Let's clear up the confusion right away. A loan modification is not a refinance. When you refinance, you're essentially paying off your old loan by taking out a completely new one, usually with a different lender, to get a better interest rate or terms. A modification is different. A loan modification is a permanent change to the original terms of your existing mortgage, made with your current lender. Think of it like this. Refinancing is like trading in your old car for a new one. A modification is like taking your current car to a master mechanic who overhauls the engine to make it run more efficiently and affordably for the long haul. You keep the same car, the same title, but the performance, the monthly payment, is fundamentally improved. The goal is simple: to make your monthly mortgage payment affordable based on your current financial hardship. To do this, the lender can change one or more of the core components of your original loan agreement. The three most powerful levers they can pull are the interest rate, the loan term, and the principal balance. First, the interest rate. This is one of the most common tools in a modification. Let's say you got your mortgage when rates were at 6.5%, but now you're in financial trouble. The lender might agree to permanently lower your interest rate to 4% or 3%, or whatever number makes the payment work for both of you. This single change can slash hundreds of dollars off your monthly payment instantly. Second, the loan term. A standard mortgage is 30 years, or 360 monthly payments. In a modification, the lender can extend that term. They might take your remaining 25 years and stretch it back out to 30 years, or even out to 40 years. Now, this does mean you'll be paying for a longer period of time, and potentially more interest over the life of the loan. But in a crisis, the immediate goal isn't minimizing total interest. It's maximizing monthly cash flow and saving your home from foreclosure. A longer term means smaller monthly payments, which can be the lifeline you desperately need. Third, and this is the most powerful one, is changing the principal balance itself. This is the total amount you still owe on the loan. In some cases, a lender might agree to what's called a principal forbearance or a principal reduction. With a forbearance, they take a chunk of what you owe, say $50,000, and they set it aside. You don't have to make payments on it, and it doesn't accrue interest. It just sits there, and you typically only have to pay it back when you sell the house, refinance, or reach the end of the loan term. A principal reduction is even better, though less common. This is where the lender agrees to forgive a portion of your debt entirely. They just wipe it off the books. This is often used in situations where the homeowner is severely underwater, meaning they owe significantly more on the mortgage than the house is actually worth. A modification can use any one of these strategies, or more often, a combination of all three, to engineer a new, affordable monthly payment. The lender takes all your past due amounts, the missed payments, the late fees, the penalties, and they typically roll it all back into the new modified loan balance. So you get a fresh start. One new loan, one new affordable payment, and the threat of foreclosure is gone. This all sounds great for the homeowner, right? But it begs the most important question. Why on earth would a bank agree to this? Why would they willingly agree to take less money from you than you originally promised to pay them? It seems to run against every principle of business. The answer lies in understanding one simple, brutal economic reality. Foreclosure is a financial disaster for lenders. When you stop paying your mortgage, your loan becomes what they call a non-performing asset. It's a dead weight on their balance sheet. Their first goal is to try and make it perform again. But if they can't, their only other option is foreclosure. Let's look at what that actually costs them. First, there are the legal fees, which are astronomical. They have to hire expensive attorneys to navigate a complex and lengthy state-by-state legal process. Second, while the house is in foreclosure, they are on the hook for property taxes, insurance, and basic maintenance. They have to prevent the house from falling into disrepair, which costs a fortune. Third, after they finally take ownership of the property, they have to sell it. This means paying real estate commissions, more maintenance, and dealing with the uncertainty of the market. And homes sold in foreclosure auctions often sell for far less than their actual market value. When you add it all up, the legal bills, the carrying costs, the sales commissions, and the final discounted sale price, a lender can easily lose 30, 40, or even 50% of the loan's value in a foreclosure. It is a catastrophic financial loss for them. So they run a calculation. They use a model called a net present value, or NPV test. It's a fancy term for a simple question. Which option makes us lose less money? Option A is foreclosure, with all its guaranteed high costs and uncertain sale price. Option B is modifying your loan, lowering your interest rate and payment, but in exchange getting a steady, reliable stream of payments from you for years to come. More often than you'd think, the math proves that keeping you in your home with a modified payment is the far more profitable, or at least less costly, option for the bank. A loan modification isn't an act of charity. It's a calculated business decision. It's a negotiation where, if you play your cards right, you can create a win-win scenario. You get to keep your home with a payment you can actually afford, and the bank gets to turn a non-performing asset back into a performing one, avoiding the financial black hole of foreclosure. Understanding this dynamic is the key. You are not begging for a handout. You are proposing a viable business solution to a mutual problem, and that is where your power lies. So let's talk about that power. It stems from a very simple, very cold, hard fact. Your mortgage servicer, the company you send your check to every month, is not in the real estate business. They are in the cash flow business. A foreclosure is a catastrophic failure of that business model. Think about it from their perspective. A foreclosure isn't just one legal action. It's a cascade of costs. They have to hire attorneys, which costs thousands. They have to pay court filing fees. They have to maintain the property while it's in limbo, paying for lawn care, utilities, and insurance on a vacant house. They have to deal with the risk of vandalism or neglect, which can plummet the property's value. And after all that, they have to sell the house, often at a steep discount in a share of sale or auction, just to recoup a fraction of their losses. The entire process can take months, sometimes years, during which they receive zero payments. It is a logistical and financial nightmare for them. A successful loan modification, on the other hand, it's elegant. It's clean. It takes a non-performing asset, your struggling loan, and with a few strokes of a pen, turns it back into a performing asset. The cash flow starts up again. It might be a smaller stream of cash than before, but a predictable stream is infinitely better than a money pit. This is the fundamental truth you must internalize. You are not asking for charity. You are presenting a business proposal that is, in almost every scenario, vastly superior for the lender than the alternative of foreclosure. So, with that foundation laid, what exactly is a loan modification? Let's strip away all the jargon. At its core, a loan modification is a permanent change to one or more of the original terms of your mortgage loan. That's it. It's not a new loan. It's not a temporary pause. It's an official, legally binding alteration of your existing agreement, designed to make your monthly payment affordable for the long term. Think of your original mortgage contract as a rigid, unchangeable document carved in stone. A modification is the process of taking a chisel to that stone and carefully recarving a few key parts. The servicer has a few primary tools or levers they can pull to achieve this. The first and most common lever is the interest rate. They can lower your interest rate for a set period, or even for the remaining life of the loan. This is often the first thing people think of, and for good reason. Even a small reduction can have a significant impact. Let's say you have a $300,000 loan balance at a 6.5% interest rate. Your principal and interest payment is about $1,896 a month. If the servicer modifies that rate down to 4.5%, your payment drops to about $1,520. That's a savings of nearly $380 every single month. For a family struggling to make ends meet, that isn't just a small change. That's the difference between keeping your home and losing it. That's groceries for the month. That's the car payment. It's breathing room. The second lever is the loan term. This means extending the amount of time you have to pay the loan back. Most mortgages start as 30-year or 360-month loans. A modification can stretch that timeline out. Maybe you've been paying on your loan for 10 years, so you have 20 years left. The servicer could re-extend your loan term back out to 30 years, or in some cases even to 40 years. Now, this is a double-edged sword. By extending the term, you are spreading the remaining balance over a much longer period, which drastically lowers the monthly payment. However, it also means you'll be paying more in total interest over the life of the new longer loan. But let's be clear. When you're facing foreclosure, the primary objective is survival. It's about reducing your monthly payment to a number you can actually afford right now. The long-term interest cost is a secondary concern when the immediate threat is losing the roof over your head. The third lever is the most powerful and often the most misunderstood. It's called principal forbearance, or sometimes principal deferment. This does not mean your debt is forgiven. Let me repeat that. It is not forgiveness. Instead, the servicer takes a portion of your principal balance and sets it aside. They essentially put it on ice. This deferred amount is still owed, but it sits in the background, not accruing any interest, and it doesn't have to be paid back until the very end of the loan, when you sell the house, refinance, or pay the mortgage off completely. At that point, it comes due as a lump sum balloon payment. Let's use our $300,000 loan example again. Let's say the servicer determines that to get your payment to an affordable level, they need to calculate it based on a balance of only $220,000. They will take the other $80,000 of principal and defer it. So your monthly payments are now calculated on a much smaller loan balance, which dramatically reduces your payment. That $80,000 doesn't vanish. It just waits patiently at the finish line. This is an incredibly effective tool because it can create a massive reduction in the monthly payment without the lender having to actually write off any of the debt. They still expect to get all their money back eventually. They're just restructuring how and when it gets paid. The fourth and final lever is the one everyone hopes for, but it is by far the rarest. This is principal reduction, also known as principal forgiveness. This is exactly what it sounds like. The lender agrees to permanently erase a portion of your debt. They simply write it off. For example, they could take that $300,000 loan and agree to forgive $50,000, permanently reducing your balance to $250,000. As you can imagine, lenders and investors are extremely reluctant to do this. It represents a direct, irreversible loss for them. It's typically a last resort, used only in very specific circumstances, like in areas where property values have plummeted so severely that the homeowner is underwater by a massive amount, owing far more than the house is worth. While it does happen, it is not the standard outcome, and it's crucial to manage your expectations. Going into this process expecting principal forgiveness is usually a recipe for disappointment. Now, a successful loan modification is rarely just one of these things. It's almost always a combination, applied in a specific order. This is what's known in the industry as a waterfall. The servicer first tries to lower the interest rate. If that alone doesn't get your payment to the target affordable level, they then move to the next step in the waterfall, extending the term. If that combination still isn't enough, they move to the next step, deferring some of the principal. And only if all else fails might they even consider the final, drastic step of principal reduction. They apply these tools in order until they hit the magic number, a monthly payment that you can afford. It's also critical to understand what a loan modification is not. It is not a forbearance. A forbearance is a temporary pause or reduction in your payments, usually for a few months, granted for a short-term hardship. It's a band-aid. A modification is a permanent solution. It's surgery. And most importantly, a loan modification is not a refinance. A refinance is when you apply for a brand new loan, with brand new terms, to pay off and replace your old loan. To qualify for a refinance, you need good credit, a stable income, and equity in your home. People seek a modification precisely because they can't qualify for a refinance. A modification is for homeowners who are in financial hardship, who may have damaged credit, and who need help with their existing loan because the option of getting a new one is off the table. This distinction is the entire point. It is a lifeline, not a standard financial product. It is a workout option designed to fix a problem, not a tool for financial optimization. Understanding this difference is key to navigating the road ahead. So what does this road ahead actually look like? When you're in financial distress and you approach your lender for a modification, what are they actually capable of doing? What's in their toolbox? Because that's the best way to think about it. Your mortgage servicer has a specific set of tools they can use to try and fix your loan. A modification isn't one single thing. It's the unique combination of these tools that they apply to your specific situation. The first and most common tool they pull out is the interest rate reduction. This is the heavy hitter. For most people, the interest rate is the single biggest factor determining their monthly payment. So, the lender looks at your current rate, let's say it's 6.5%, and they look at the current market rates. They have internal guidelines, but their goal is to lower your rate to a point that significantly reduces your payment. They might bring it down to 5%, maybe 4.5%, sometimes even lower depending on the program and the prevailing rates at that time. This is not a refinance. You're not going through a new application process with credit scores and appraisals in the same way. This is your existing lender agreeing to change the terms of your existing contract to make it sustainable. The impact is immediate and powerful. A 2-point drop in your interest rate on a several $100,000 loan can easily slash your monthly payment by hundreds of dollars. This is often the first step in what's called the waterfall. But what if a rate reduction alone isn't enough? What if, even at a lower market rate, the payment is still too high for your current income? That's when they reach for the second tool. Extending the loan term. Let's say you're 10 years into a 30-year mortgage. You have 20 years or 240 payments left. To further reduce your monthly payment, the lender can re-amortize your loan over a new, longer period. They might take your remaining balance and stretch it back out over a full 30 years, or 360 payments. In some cases, especially with government-backed programs, they can even extend it to a 40-year or 480 payment term. Now let's be crystal clear about the math here. When you stretch the term, you are lowering your monthly payment, which is the immediate goal. But you are also agreeing to make payments for a longer period of time, which means you will ultimately pay more in total interest over the life of the new loan. This is a critical trade-off. A modification is not designed to save you the most money in the long run. It is designed to save your home right now. It prioritizes immediate affordability over long-term cost savings. And for someone facing foreclosure, that is the right priority. The lender isn't doing this out of the kindness of their heart. They're doing it because a performing loan, even with modified terms, is almost always better for them than a costly and complicated foreclosure. So, very often they will use these first two tools in combination. They'll lower your interest rate and extend your term to get that monthly payment down to an affordable level. Okay, but let's say they've done both. They've dropped the rate, they've extended the term to the maximum 40 years, and the numbers still don't work. Your income is just too low to support the payment even after those adjustments. Are you out of luck? Not necessarily. This is where they bring out a more specialized and powerful tool. Principal forbearance, also known as a principal deferment. This is a concept that confuses a lot of people, so let's break it down. Principal forbearance is not principal forgiveness. They are not erasing part of your debt. Instead, they take a portion of your principal balance and set it aside. They essentially put it in a box, and that box gets put on a shelf. You stop making payments on that portion of the loan, and in most cases, you stop accruing interest on it. Your new, lower monthly payment is then calculated based on the remaining balance. Let's use an example. Imagine you owe $350,000 on your home. After a rate and term modification, your payment is still too high. The lender's calculation shows that you can only afford a payment based on a $280,000 loan balance. So, they might defer $70,000 of your principal. That $70,000 is still a lien against your property. You still owe it, but it's a non-interest-bearing balloon payment that isn't due until the very end of your loan. When is it due? Typically, when you either sell the house, refinance the mortgage, or pay the loan off in 30 or 40 years. At that point, the $70,000 comes due all at once. It's a way of kicking a piece of the problem down the road, a very, very long road, to solve the immediate crisis of an unaffordable monthly payment. For many homeowners, this is the tool that makes the difference between staying and leaving. Now, this brings us to the fourth and final tool, the one everyone asks about, the one whispered about like a myth, principal reduction. This is also called principal forgiveness. This is where the lender agrees to simply erase a portion of your debt. Gone. Forgiven. You owed $350,000, and now you only owe $300,000. Sounds amazing, and it is. It is also the absolute rarest of all modification tools. Following the 2008 housing crisis, there were specific government programs that did include principal reduction, especially for homeowners who were severely underwater, meaning they owed far more on their mortgage than their home was worth. But in today's market, it is almost unheard of. Why? Because for a lender, forgiving principal is a direct, quantifiable loss on their books. The other tools, rate reduction, term extension, even forbearance, are ways of restructuring the debt to maximize the chances of getting paid back. Principal forgiveness is just writing off money. So while you may read about it online, you should go into this process with the firm expectation that it will not be an option. If it happens, it's like winning the lottery, but you cannot build your strategy around it. So you have these four tools: rate reduction, term extension, principal forbearance, and the unicorn principal reduction. But how does the lender decide which ones to use? Is it random? Do you get a better deal if you get a nicer person on the phone? Absolutely not. It's a cold, hard calculation. Lenders follow a strict step-by-step process I mentioned earlier called the waterfall. Think of it like a series of steps. At the top of the waterfall is your current unaffordable payment. The lender's goal is to get that payment down to a target number. That target is usually around 31% of your gross monthly income. So they apply the first tool. Step 1. They reduce the interest rate to the current market rate. Then they check. Does this get the payment to the 31% target? If yes, they stop there. That's your modification. If no, they go to the next step. Step 2. They keep the new, lower interest rate and extend the term to 360 months. They check again. Does this hit the target? If not, they go to step 3. Extend the term to 480 months. Still not there. Then they move to step 4. Principal forbearance. They calculate the exact amount of principal they need to defer to make the payment, based on the new rate and 40-year term, finally hit that 31% target. It's a rigid, emotionless sequence of calculations. This is crucial to understand. Pleading your case or writing a heart-wrenching letter about your situation might be part of the application, but it doesn't change the math of the waterfall. The servicer is simply plugging your financial information, your income, your other debts, your property taxes and insurance, into a formula and seeing what the formula spits out. They are trying to fit your square peg into their round hole, using these tools to shave down the edges until it fits. Understanding this waterfall process is like being given a peek at the other team's playbook. It demystifies the entire process. It shows you that the outcome isn't arbitrary. It's based on a very specific logic. Your job isn't to convince them to like you. It's to provide them with the accurate financial documentation they need to run their waterfall calculation correctly. So the lender has this entire toolkit, this step-by-step waterfall, all designed to hit a specific number. But this raises the most important question of all. How do they decide who gets to access this toolkit in the first place? What are the secret eligibility requirements you have to meet? That's what we're breaking down next. First, let's get one thing straight. There is no single, universal checklist for loan modification eligibility. It's not like applying for a credit card where if your score is above a certain number, you're in. It's more like a puzzle. Your lender, or more accurately, the investor who actually owns your loan, has a picture they want to create. Your financial documents, your story, your income. These are the pieces. Your job is to give them all the right pieces so they can assemble that picture and see that a modification is the best solution for everyone involved. So, what does that picture need to look like? It's built on a few core pillars. The first and most important pillar is a legitimate, verifiable financial hardship. This is the non-negotiable entry ticket. You can't just want a lower payment because your neighbor refinanced to a great rate. You have to prove that a specific significant life event has occurred that has directly impacted your ability to afford your original mortgage payment. Think of it as a cause and effect relationship. The cause could be a job loss or a significant reduction in income. It could be a serious illness or disability for you or a family member, leading to massive medical bills and time away from work. It could be a divorce or the death of a spouse, which often cuts the household income in half overnight. Another common one is a sudden, large increase in your mortgage payment, like when the introductory period on an adjustable rate mortgage, or ARM, ends and the payment skyrockets. Even a disaster, like a flood or fire that your insurance didn't fully cover, can qualify. The key word here is verifiable. You can't just say, "I lost my job." You'll need to provide the termination letter. You can't just say, "My income went down." You'll need to show the pay stubs before and after the reduction. For medical issues, you might need to provide documentation from a doctor without revealing private health information that confirms the timeline of the illness. You are building a case, and every claim needs an exhibit, a piece of evidence to back it up. This hardship must also have a clear timeline. Lenders want to see that you were making your payments just fine before the event, and the trouble started after. This shows them you're a responsible borrower who fell on hard times, not someone who was always struggling. Now, this leads us to the second, and arguably the most confusing pillar of eligibility: sufficient income. This is the great paradox of loan modification. You have to prove you're in a financial hardship so severe you can't afford your current payment, but you also have to prove you have enough stable income to afford a new modified payment. This is where the majority of denials happen. It's a tightrope walk. Fall too far on one side and you don't have a real hardship. Fall too far on the other, and you don't have the ability to repay even on new terms. Lenders determine this using a critical metric, your debt-to-income ratio, or DTI. Imagine your total gross monthly income, that's your income before any taxes or deductions are taken out, is one big pizza. Your DTI is the percentage of that pizza that's already been claimed by your debts. Lenders look at two slices of this pizza. The first is the front-end ratio. This is just your housing payment, your proposed new mortgage principal, interest, taxes, and insurance, divided by your gross monthly income. Most modification programs want this number to be somewhere around 31%. So if you make $6,000 a month gross, they want your new total housing payment to be around $1,860 or less. But they don't stop there. They also look at the back-end ratio. This is the big one. It's your total monthly debt payments, including that new, modified mortgage payment, plus your car loan, your student loans, your credit card minimum payments, everything, divided by your gross monthly income. The target for this number can vary, but it's often in the ballpark of 43% to 55%, depending on the loan program. If your income is too low, and even after they reduce your payment as much as possible, your DTI is still too high, they will deny the application. Their logic is cold but simple. Approving a modification you still can't afford helps no one. It just delays the inevitable foreclosure, costing both you and the investor more money and stress in the long run. This is why having some form of stable, documented income is absolutely crucial. It can be from a new job, unemployment benefits, Social Security, disability, or even documented, consistent contributions from family members. But it has to be there, and it has to be enough to fit within those DTI guardrails. The third pillar is the property itself. Overwhelmingly, loan modification programs are designed for a borrower's primary residence. This is the home you actually live in. If you're seeking a modification for a second home, a vacation cabin, or an investment property you rent out, your chances of approval drop dramatically. It's not impossible, but it is much, much harder. The government-backed programs, in particular, are almost exclusively focused on sustainable homeownership and keeping families in their homes. The logic is that if you're facing hardship, you'd be expected to sell an investment property before you'd stop paying the mortgage on the roof over your own head. So, if you're a homeowner living in the property that has the mortgage, you've cleared this hurdle. Fourth, we have the loan type and ownership. This is a behind-the-scenes factor that has a huge impact on your options. Not all mortgages are the same. Is your loan a conventional loan, likely owned by Fannie Mae or Freddie Mac? Is it an FHA loan, insured by the Federal Housing Administration? Or a VA loan, guaranteed by the Department of Veterans Affairs? Maybe a USDA loan for a rural property? Each of these loan types has its own unique set of modification programs and rules. FHA loans, for example, have a specific waterfall of options they must go through, like the FHA HAMP program. Fannie and Freddie have their own set of proprietary modification options. The investor who owns your loan dictates the toolkit we talked about in the last part. You can't get an FHA modification on a conventional loan, and vice versa. So, a critical early step for you is to identify what kind of loan you have. It's usually stated on your original closing documents or your monthly mortgage statement. Knowing this will tell you which set of rules you'll be playing by. Finally, the fifth pillar, which ties everything together, your documentation. You must be willing and able to provide a mountain of paperwork. The lender isn't just going to take your word for it. They need to build a complete financial snapshot of you. This means you will need to gather your most recent tax returns, pay stubs for the last 30 to 60 days, and bank statements for all of your accounts for the last 2 or 3 months. If you're self-employed, you'll need a year-to-date profit and loss statement. And you will need to write a hardship letter. This is your chance to tell your story. It should be a clear, concise, one-page letter explaining what your hardship is, when it began, and why it was out of your control. It should connect the dots for the lender, explaining how this event directly led to you being unable to afford your mortgage. This isn't a place to complain about the bank or the economy. It's a factual, professional explanation of your circumstances. Think of this entire package as your formal proposal. You are proposing that the investor makes a change to a multi-$100,000 contract. To do that, you need to present a bulletproof case. You need to prove the hardship, demonstrate you have enough income to support a solution, confirm you live in the property, and provide every single document they ask for in a timely manner. Meeting these eligibility requirements is your ticket to being seriously considered for a solution. So now you know what the lender is looking for. You know the 5 main pillars they use to judge your case. But knowing the rules of the game is one thing. Actually playing it is another. How do you take all this information and turn it into a successful application? What are the common mistakes that get people instantly denied, even if they meet all these criteria? That's the crucial next step in this journey. The application process isn't a form you fill out. It's a case you build. It's a meticulously crafted argument you present to a judge and jury who are actively, financially incentivized to rule against you. Your lender's loss mitigation department isn't your friend. They are gatekeepers. And their default answer, the easiest answer for them, is always no. Our job is to make it impossible for them to say no. We need to build a fortress of facts, a story so clear and compelling that denying you would be illogical. The single biggest mistake people make, right from the start, is treating this like they're applying for a credit card. They fill out the forms, send them in, and hope for the best. That is a guaranteed path to failure. You have to become the project manager of your own survival. And the very first thing you need to do is establish your single point of contact, or SPOC. Federal law often requires your servicer to assign you one person, a specific employee, to be your liaison through this entire process. Do not proceed until you have their name, their direct extension or email, and you confirm they are your assigned SPOC. This person is your lifeline. They are also the person who can drop the ball, lose your paperwork, or misinterpret a key detail that gets you denied. From this moment forward, you will document every single interaction with your SPOC. Every phone call gets a follow-up email. Hi Jane, just to confirm our conversation today at 2:15 p.m. We discussed X, you requested Y, and the next step is Z. Please let me know if this doesn't match your understanding. You are creating a bulletproof paper trail. Now let's talk about the application package itself. This is your arsenal. It usually consists of 4 or 5 key components. The first is the Request for Mortgage Assistance or RMA form. This is the skeleton of your case. It's where you list your income, your assets, your expenses, and the details of your hardship. The number 1 mistake on the RMA form? Inconsistency. The income you list here must perfectly match the income on the pay stubs you provide. The balance you list for your checking account must be verifiable on the bank statements you're about to submit. They will cross-reference every single number. If your monthly grocery bill on this form is $500, but your bank statements show you're spending $1,000 at restaurants, you're done. Instant denial for misrepresentation. Be precise, be honest, and be consistent. Next, and arguably the most important document in the entire package, is your hardship letter. This is the soul of your application, and it's where most people get it tragically wrong. They either write a one-sentence generic plea, Or they write a 10-page emotional rant blaming the economy, their boss, or the bank itself. Both are wrong. A successful hardship letter is a clear, concise, professional one-page business document that tells a story. It has a beginning, a middle, and an end. The beginning. State the purpose of your letter immediately. I am writing to formally request a loan modification for my property at 123 Main Street due to a financial hardship. Get straight to the point. The middle. This is the core of your story. Explain the hardship. It must be a specific, verifiable event. Not things got tough. It's in May of 2023. I was laid off from my job of 12 years at XYZ company due to corporate restructuring. Or, my spouse suffered a major medical event on this date, resulting in these specific medical bills and a significant loss of household income. State the facts. What happened and when did it happen? Then, you connect that event directly to your inability to pay the mortgage. As a direct result of this job loss, our monthly income has decreased by 40%, making our current mortgage payment of $2,500 unaffordable. Show the cause and effect. The end. This is crucial. You must demonstrate that the hardship is either over or is now stable, and that you have a plan for the future. This is what tells the bank you're a good risk again. For example, I have since secured a new full-time position as of September 2023, and while my new income is stable, it is less than my previous role. A modified payment would be sustainable for the long term. Or, my spouse has completed their medical treatments, and we are no longer incurring new medical debt. Our financial situation has stabilized, and with a modification, we can resume consistent payments. Never end on a note of desperation. End on a note of responsible, forward-looking planning. Keep it to one page. No emotion, no blame, just the facts of your story. Now for the evidence that backs up your story. Your proof of income. If you're a W-2 employee, this is simple. Your last 30 or 60 days of pay stubs and maybe your last 2 years of W-2s. The mistake here is sending outdated information. If they ask for your most recent pay stubs, don't send ones from 2 months ago. If you get paid again while you're gathering documents, send the new one. Always send the most current information possible. If you're self-employed, this is harder. You'll need a year-to-date profit and loss statement, or P&L. This is a simple document showing your business revenue minus your business expenses, leaving you with your net income. The mistake self-employed people make is submitting a messy, confusing, or unprofessional-looking P&L. It needs to be clear. Even more importantly, the net income on your P&L has to logically align with the deposits going into your bank account. If your P&L claims you make $5,000 a month, but you're only depositing $2,000, they will deny you. This brings us to the most scrutinized documents of all, your bank statements. They will ask for the last 2, 3, maybe even 6 months of statements for every single account you have. You need to think like a forensic accountant. They will go through these line by line. They are looking for 2 red flags. First, undisclosed income. Any large, unusual deposit will be questioned. That $50 birthday check from your aunt? Fine. That $3,000 cash deposit? You better have a signed letter explaining exactly where that came from, and proof it was a one-time gift and not regular undeclared income. Second, and this is where people get sunk, they are looking for what they consider frivolous or excessive spending. I have seen people denied because their bank statements showed weekly trips to expensive restaurants, multiple streaming service subscriptions, a new car payment they didn't disclose, or consistent online shopping sprees. In the bank's eyes, if you can afford that, you can afford your mortgage. Before you submit your statements, you need to live on a crisis budget. Cut everything non-essential. Your statements must reflect a person in a genuine hardship, making every effort to save their home. Finally, your tax returns, usually the last 2 years filed. They want to see the big picture of your financial history. The mistake here is simple. Your tax returns tell a different story than what you're telling them now. If your tax returns show a thriving business making $200,000 a year, but your P&L now shows you're barely making ends meet, you need to explain that discrepancy in your hardship letter. Once you have this entire fortress of documentation built, do not just mail it. Scan every single page and save it as a single PDF file on your computer. Name it something clear like loan modification_date. Submit it through the lender's secure online portal if they have one. This is the best way as it provides a digital timestamp. If you must mail it, send it via a trackable method like certified mail so you have a signature confirmation that they received it. After you send it, you wait 48 hours and then you call your SPOC. Hi Jane. I'm calling to confirm you have successfully received the complete application package I submitted on this date. Do not assume they have it. Confirm it, get a verbal confirmation, and then send your follow-up email. Your case is now officially submitted. But the fight, the real test of your resolve, has only just begun. The waiting game, the endless requests for one more document, and the psychological warfare of the review process. That's what comes next. You've sent the package. It's gone. You might have even paid for tracking and delivery confirmation just to see the moment it arrived at some anonymous P.O. box in a city you've never been to. And now silence. This is the first stage of the psychological gauntlet. The deafening quiet. Days turn into a week. A week turns into 2. You check your email 100 times a day. You watch the mailbox like a hawk. Every phone call from an unknown number sends a jolt of adrenaline through your system. You're living in a state of suspended animation, your entire financial future held in a manila folder on someone's desk somewhere. This period isn't an accident. It's part of the process. It's designed, whether intentionally or not, to wear you down, to make you anxious, to make you second-guess yourself. Did I fill out Section 3B correctly? Did I sign on the right line? Did they even get it? Then finally you get a letter or an email. Your heart pounds as you open it. This is it, the decision. But it's not. It's a letter stating your application is incomplete. They'll say something like, "We are in receipt of your request, however, in order to proceed, we need a more recent bank statement." Or, "The enclosed pay stub is illegible." Or my personal favorite, "You failed to provide page 4 of your bank statement," even though you know for a fact that page 4 was the blank back page that you deliberately didn't send. Welcome to the document vortex. This is the single most frustrating part of the entire ordeal, and it's where the vast majority of homeowners give up. Feels like a game. A cruel bureaucratic game where the rules are constantly changing. You send a document, they wait 2 weeks, then they ask for the same document again because the one you sent is now stale. Let's define stale. In the world of mortgage servicing, most financial documents have a shelf life. A pay stub or a bank statement is typically considered current for only 30 days. So, if your servicer takes 29 days to look at your file after you send it, your documents are on the verge of expiring. If they take 31 days, congratulations, you get to start the scavenger hunt all over again. They're not necessarily doing this to be malicious, though it certainly feels that way. The system is just that slow, that inefficient. An underwriter finally gets your file, sees a pay stub dated 45 days ago, and their internal rules require a more recent one. So they kick it back. And the clock on all your other documents keeps ticking. This is why, from the moment you submit your application, you must continue to save every single new financial document you receive. Every pay stub, every bank statement, every utility bill. Keep them organized in a folder, ready to be deployed at a moment's notice. Because you will be asked for them. It's not a matter of if, but when. Now, during this chaotic back and forth, you're supposed to have an ally. Federal regulations established after the 2008 crisis mandate that once you apply for loss mitigation, your servicer must assign you a single point of contact, or SPOC. This sounds great, right? One person who knows your case, who you can call directly, who will guide you through the process. That is the ideal. The reality is often very different. Your SPOC is rarely one specific person named Bob or Susan who sits in a quiet office managing your file. More often than not, your single point of contact is actually a team, a department, or a call center. You'll call the number you were given and get a different person every single time. You'll have to re-explain your entire situation from the beginning only to be told, "I see a note here, let me check on that." They are often reading from a script on a screen. They have limited authority and often no direct contact with the person who actually makes the decisions, the underwriter. So, how do you manage this? You become the ultimate project manager of your own survival. First, every time you call, get the name and agent ID number of the person you're speaking with. Write it down. Date, time, name, ID. Second, after every single phone call, you will send a follow-up email to the servicer's general loss mitigation email address. In that email, you will summarize the conversation. Per my conversation with Jane, agent ID 742, at 2:15 p.m. Eastern Time today, I was informed that you need a new bank statement for February. I have attached it to this email. Please confirm receipt. This creates a paper trail, creates accountability. When they come back 3 weeks later and say they never got it, you don't just have to rely on your memory. You have a digital, time-stamped receipt of your communication. You are building a case not just for your modification but for your own sanity. While you're battling the document vortex and navigating your so-called SPOC, your file is slowly making its way to the mysterious figure known as the underwriter. This is the person in the back room who you will never speak to, but who holds your fate in their hands. The underwriter's job is not to listen to your story or empathize with your hardship. Their job is to run numbers through a complex, predetermined formula. This formula is often called the waterfall. Think of it as a series of tests. Your application is poured into the top of the waterfall, and the system checks to see if you qualify for the first program. This used to be the old federal HAMP program. If you don't qualify, your file flows down to the next level. Maybe that's an internal proprietary modification program that the bank has created. If you don't fit the criteria for that, it flows down again. Maybe to an FHA HAMP modification if you have an FHA loan, or a VA modification for a VA loan, and so on down the waterfall until it either finds a program you qualify for, or it runs out of options at the bottom. What are they looking for? Two primary things. First, can you afford the modified payment? They'll calculate your debt-to-income ratio. They're looking for that sweet spot where the new payment is affordable for you, but also maximizes the return for the investor who owns your loan. Second, they run what's called a net present value or NPV test. This is a cold, hard calculation. They're comparing the financial outcome of modifying your loan versus foreclosing on it. Which option will make the investor more money in the long run? If the NPV test comes out positive, it means modification is the better financial choice for the investor. If it's negative, foreclosure is. Your personal story, your hardship, means nothing to this algorithm. And while all of this is happening in the background, another more terrifying process might be running in parallel. It's a practice called dual tracking. This is when the servicer's foreclosure department continues to actively pursue foreclosure on your home. At the same time, the loss mitigation department is reviewing your modification application. You could be on the phone sending in a pay stub on a Monday, and on Tuesday, a notice of a sheriff's sale gets taped to your front door. Now, there are federal rules that are supposed to prevent the worst of this. A servicer is generally not supposed to start a foreclosure if you've submitted a complete application, and they are not supposed to conduct a final foreclosure sale while your application is under review. But supposed to is the key phrase. Mistakes happen, wires get crossed between departments, and some servicers push the boundaries of the rules. This is why you cannot ignore any legal notices you receive. The modification process does not automatically stop the foreclosure process. They are two separate trains running on parallel tracks, and you have to keep an eye on both. Weeks, maybe even months of this grind will pass. You've sent documents, resent documents, called, emailed, documented everything. You feel exhausted, beaten down. You've done everything they've asked. And then one day the status of your online portal changes, or another official-looking envelope arrives. This one feels different. It's thick. Your hands might be shaking as you open it. This is the moment of truth. A decision has finally been made. But the war is far from over. Because what's inside that envelope could be one of three things: an outright denial, a request for more information, or the thing you've been fighting for, an offer. But that offer, the trial period plan, comes with its own set of rules, its own traps, and its own crucial tests you have yet to face. This is it. The letter you've been waiting for. It's called a trial period plan, or TPP. And on the surface it looks like victory. It outlines a new, lower monthly payment for a trial period, usually 3 months. 3 payments to prove you can handle the new terms. You make these 3 payments on time, and the modification becomes permanent. Simple, right? Wrong. This is not the finish line. This is the final, most treacherous part of the obstacle course, and the majority of people who get this far still fail right here. Because the trial period plan is designed as a test, and it has one purpose: to see if you will break. First, you need to understand what this plan actually is. It is a conditional offer. The lender is saying, we might give you a permanent modification, but first you have to prove it to us. That new payment amount they give you? It's an estimate. It's their best guess of what your final payment will be after they re-amortize the loan, capitalize the arrears, and adjust the interest rate. But it is not a guarantee. Can and sometimes does change when the final offer comes. But for the next 3 months, that trial payment is your new reality. And it comes with one single, non-negotiable, absolutely critical rule. You must make every single payment in full on or before the due date. Not 1 day late. Not $1 short. If your payment is due on the 1st of the month, it needs to be in their hands on the 1st of the month. Not postmarked. Not in transit. Received. If it arrives on the 2nd, you have failed the test. The trial is terminated and you are thrown right back to square one, only now you're 3 months further behind, with the threat of foreclosure looming larger than ever before. There are no excuses. No second chances. A family emergency, a lost check in the mail, a bank holiday you forgot about. None of it matters. To them, it's a simple binary choice. You either made the payment on time or you didn't. This is the lender's ultimate stress test. They want to see if you have the discipline and the financial stability to meet your obligations under pressure. My advice? Pay it online at least 5 business days before it's due. Get a confirmation number. Screenshot the confirmation page. Treat it like a life or death mission because for your home it is. But this is where the first major trap is hidden. It's a detail so small, so buried in the fine print, that it blindsides thousands of homeowners every single year. It's called the escrow shortage, and it leads to something called payment shock. You see that new lower trial payment and you feel a wave of relief. You can finally breathe. But what you might not realize is that the lender, during this 3-month trial, may have stopped paying your property taxes and your homeowner's insurance out of your monthly payment. That trial payment might only be covering the principal and interest. They do this to make the trial payment as low as possible, to test your ability to pay something. So for 3 months you're making your payments feeling great. But in the background, your property tax bill is going unpaid. Your homeowner's insurance premium is due. The lender isn't covering it. So when the trial period ends and they calculate your permanent modified payment, they suddenly have to account for a massive new escrow shortage. All those unpaid taxes and insurance premiums now have to be collected. So they take that shortage, divide it by 12, and tack it onto your new monthly payment. And suddenly, that affordable payment you were quoted in the trial plan skyrockets by hundreds, sometimes even $1,000 or more per month. It's a devastating blow. You passed the test, you did everything right, only to be handed a final payment that is just as unaffordable as your original one. You've been tricked. And it's perfectly legal. You must read the trial plan documents with a microscope. Find the section on escrow. If it's unclear, you have to call your servicer and ask them point blank, in no uncertain terms. During this trial period, are you, the servicer, paying my property taxes and homeowner's insurance? Or am I responsible for paying them directly? Get the answer in writing if you can. If you are responsible, you need to budget for those costs separately. You need to know the true cost of keeping your home during this period, not just the artificially low number on the trial plan letter. Do not let yourself be a victim of payment shock. Now let's talk about the second psychological test you're about to face. The communication blackout. You make your first trial payment. You get a confirmation. Then silence. You make your second payment. Confirmation. And then more silence. The phone calls from the collections department stop. The threatening letters cease. Your case manager, who you might have been speaking to weekly, suddenly doesn't return your calls. It can feel like your file has fallen into a black hole. This is where panic sets in. Did they forget about me? Did I do something wrong? Is the deal off? This radio silence is normal. It's terrifying, but it's part of the process. What's happening is that your file is being transferred. It's moving out of the hands of the loss mitigation department, the people who handle defaults, and is being prepared to go back to the regular loan servicing department. It's in a kind of administrative limbo. The worst thing you can do during this time is panic and stop making payments. That is an instant failure. Your only job during this period is to keep your head down, keep your mouth shut, and make your payments on time. That's it. Send the money. Get the confirmation. Mark it on your calendar. And wait. The silence is a sign that the gears of the bureaucracy are turning, not that they've stopped. So you've done it. You've navigated the traps. You've made all 3 payments on time in full. You've weathered the psychological storm of the communication blackout. What happens next? After your third and final trial payment is processed, you should expect to receive the most important document in this entire journey: the Permanent Loan Modification Agreement. This is the final contract. It will be a thick packet of legal documents that makes the new terms of your loan official and legally binding. When this packet arrives, do not just sign it in relief. This is your last chance to catch any errors. You need to become a forensic accountant. Take the agreement, a calculator, a highlighter, and sit down at your kitchen table. You are going to read every single word. First, check the big numbers. Does the new principal balance look correct? Remember, all your missed payments, late fees, and any legal costs have likely been capitalized, that is, added onto your loan balance. It's going to be higher than what you owed before you fell behind. Make sure it accurately reflects your arrears. Next, check the interest rate. Is it the fixed rate you were promised? Is it the correct percentage? Check the new term of the loan. Have they extended it to 40 years? Make sure it matches what you were expecting. And then, the most important number on the page, the final permanent monthly payment. Does it include principal, interest, taxes, and insurance? Is this the all-in number? Compare it to your trial payment. If it's significantly higher, you need to understand exactly why. Is it because of that escrow shortage we talked about? Can you truly, honestly afford this new number for the next 30 or 40 years? This is your last chance to back out. Once you sign this, there is no going back. If everything looks correct, and the payment is one you can sustain, you will need to sign it, often in front of a notary public, and send it back immediately. Do not delay. There is usually a strict deadline. Make a complete copy of the entire signed packet for your records before you mail it. Send it back using a method with tracking and signature confirmation, like FedEx or USPS certified mail. This is not the time to cheap out on postage. You need irrefutable proof that they received your acceptance. Once they receive and countersign the agreement, the modification is finalized. Your loan is officially reinstated, the foreclosure process is terminated, and you are back on track. You have successfully navigated the single most complex and stressful process a homeowner can face. But the journey isn't quite over, because living with a modified loan brings its own new set of challenges and, more importantly, opportunities. Your relationship with your mortgage and with your money has been fundamentally changed, and what you do next will determine whether this was just a temporary patch or the start of true long-term financial security. So let's talk about what comes next, starting right now, in the first 90 days of your new financial life. This period is absolutely critical. It's where you'll set the habits that will define your future. The first, most powerful action you can take is to automate your new mortgage payment. Don't even give yourself the option to be late. The moment you get that first statement with the new, modified amount, go to your bank's website or your lender's portal and set up an automatic transfer for 2 or 3 days before the due date. This isn't just about convenience. It's a psychological victory. It's you telling yourself and the world that this payment is a non-negotiable priority. It's the first brick in your new financial foundation. With that done, your next mission is to treat your new budget not as a guideline, but as law. That reduced mortgage payment is not extra money. It's not a windfall for a new TV or a vacation you feel you deserve after all this stress. It is breathing room. It is oxygen. And you need to use it to heal your finances, not just enjoy the temporary relief. You need to sit down and create a zero-based budget. This means every single dollar of your income is assigned a job before the month even begins. Income minus expenses must equal zero. If you make $4,000 a month, you need to decide where every one of those $4,000 is going. To the new mortgage payment, the car, the groceries, the utilities, and most importantly, to 2 new categories that are now your top priority: debt repayment and emergency savings. The temptation will be to relax, to feel like you can finally ease up. You must fight this with everything you have. The discipline you forged during the modification process is your greatest asset. Don't lose it now. For these first 90 days, be ruthless. Scrutinize every subscription, every coffee, every convenience purchase. The goal is to prove to yourself that you are in complete control. This period sets the tone. If you can be disciplined for 90 days, you can be disciplined for a year. If you can do it for a year, you can do it for a lifetime. Now, we need to have a frank conversation about your credit score, because chances are it's been through a war zone. The late payments leading up to the modification, and the modification itself, have likely done significant damage. You might look at your score and feel a sense of despair. Don't. A credit score is not a permanent tattoo of your financial character. It's a snapshot in time, and you have the power to change the picture. Your comeback story starts today. Rebuilding your credit after a modification is a marathon, not a sprint, and it's built on one single principle: consistency. Your number one job is to pay every single bill on time, every single month without exception. Not just the mortgage, the credit card, the car loan, the utility bill, the student loan, everything. On-time payment history is the single biggest factor in your credit score, and you need to become a machine of reliability. Set up automatic payments for everything you possibly can. For bills you can't automate, set multiple calendar reminders on your phone. There are no excuses. One late payment can halt your progress for months. Second, you need to manage your credit utilization. This is the amount of revolving credit you're using compared to your total credit limit. If you have a credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. You need to get that number as low as possible, ideally below 30%, and ultimately below 10%. This means you stop adding to the debt and you start aggressively paying it down. Use the breathing room from your new mortgage payment to make more than the minimum payment on your highest interest credit card. This is called the avalanche method, and it's the fastest way to eliminate debt and save money on interest. And a critical piece of advice: do not close old credit card accounts once you pay them off. The age of your credit history is another important factor in your score. Closing an old account shortens your credit history and can actually cause your score to drop. Just pay it off, put the card in a drawer, and maybe use it for one small planned purchase every 6 months to keep it active. Also, resist the urge to apply for new credit for at least a year. Every application creates a hard inquiry on your report, which can temporarily lower your score. Right now, your focus isn't on acquiring more credit, it's on responsibly managing the credit you have. It will take time, perhaps 12, 18, even 24 months, but by making on-time payments and paying down balances, you will see that score begin to climb step by painful, rewarding step. While you're rebuilding your credit, you must simultaneously build your financial fortress. This is your emergency fund, and it is the single most important thing that will prevent you from ever facing a mortgage crisis again. An emergency fund is not a savings account for a vacation. It's not for a down payment on a new car. It is a lockbox of cash, to be opened only in case of a true, life-altering emergency, like a job loss, a major medical event, or a critical home repair. The goal is to have 3 to 6 months worth of essential living expenses saved. Not your total income, just the bare-bones expenses you need to survive. Mortgage, utilities, food, transportation, and insurance. If that number seems impossibly large right now, that's okay. You don't build a fortress in a day. You start with a single brick. Your first goal is to save $1,000. Scrape it together however you can. Sell things you don't need. Pick up a side hustle. Cut your budget to the bone. Get that first $1,000 and put it in a separate, high-yield savings account at a different bank than your checking account. You want it to be accessible but not too accessible. You want a little bit of friction to prevent you from dipping into it for a non-emergency. Once you hit that $1,000 mini fund, you can breathe a tiny bit easier. That amount can cover a surprise car repair or a dental emergency without you having to reach for a credit card. Then you keep going. You automate a transfer, $50, $100, whatever you can afford from your new budget, from every single paycheck into that savings account. You watch it grow. That fund is your freedom. It's your peace of mind. It's the buffer between a bad day and a financial catastrophe. Every dollar you add is a vote for a more stable, secure future. Finally, you have to do the hardest work of all. You have to look in the mirror and have an honest conversation about how you got here in the first place. For some, it was a bolt from the blue, a sudden job loss, a health crisis, a divorce. It was something truly outside of your control. For others, if we're being brutally honest, the crisis was the result of 1,000 small decisions made over many years. It was a slow creep of lifestyle inflation, of using credit to cover gaps, of not having a budget or a plan. There is no shame in this. But you cannot fix a problem you refuse to acknowledge. You need to understand the root cause of your financial hardship so you can pull it out, once and for all. This requires self-awareness. Track your spending. Review your old bank statements. Identify your triggers. Do you spend when you're stressed? Do you try to keep up with friends or neighbors? Are you using buy now, pay later services to live beyond your means? This process of self-reflection is the difference between a temporary fix and a permanent transformation. The loan modification saved your house, but only you can save your financial future. It requires a fundamental shift in your mindset, from one of consumption to one of creation, from one of short-term gratification to one of long-term security. You've been given a second chance, a fresh start. The slate has been wiped clean, the payment has been reset, but the debt of your old habits remains. Paying that off will be the hardest and most rewarding work you will ever do. You've stabilized the present. You're building a plan to protect the immediate future. But what about the modification itself? Is this new loan your reality forever? What does it mean for your home's equity? And the two questions that every homeowner in your position eventually asks: can I ever refinance this modified loan into a better, traditional mortgage? And can I sell my house if I have to? Understanding the long-term mechanics of your new loan is the final piece of the puzzle. Let's tackle those two giant questions head-on, because they represent the light at the end of the tunnel. Refinancing and selling are about moving forward, about taking back control not just for today, but for your future. First, let's talk about refinancing. The dream for many homeowners with a modified loan is to eventually get back to a normal mortgage. You want to trade in the unique, sometimes complex terms of your modification for a standard, competitive 30-year fixed-rate loan from the open market. The short answer is, yes, you absolutely can refinance a modified mortgage. But, and this is a big but, not right away. Lenders call this the seasoning period. Think of it like this: you've just gone through a significant financial hardship. Your lender worked with you to create a new sustainable payment. Now they need to see you succeed. They need proof that the new arrangement is working, and that you're a reliable borrower again. The seasoning period is that proof. It's a track record of consistent, on-time payments on your new modified loan. So how long is this period? There's no single, universal answer, but the industry standard is typically between 12 and 24 months of perfect, on-time payments. For government-backed loans, the rules can be a bit more specific. For example, with an FHA loan, you generally need to have made at least 12 consecutive on-time payments under your modification agreement before you can even be considered for a new FHA refinance program like the FHA Streamline. For conventional loans backed by Fannie Mae or Freddie Mac, the requirements can be similar, often demanding a solid 24-month history of timely payments. The key here is perfection, not one late payment, not one 31-day delinquency. You are essentially rebuilding your credibility with the lending world, one successful payment at a time. During this seasoning period, your focus should be laser-sharp on two things: making that mortgage payment on time, every single time, and actively rebuilding your credit score. Remember, the events that led you to need a modification likely did some serious damage to your credit. The modification itself, while saving your home, is often noted on your credit report and can be viewed by new lenders as a sign of past risk. So, while you're making those timely mortgage payments, you also need to be paying all your other bills on time: credit cards, car loans, everything. Work on paying down other debts if you can. Your goal is to show any future lender that the hardship is firmly in the past, and you are now a low-risk, responsible borrower. Once you've crossed that 12 or 24-month threshold and have seen your credit score recover, you can start shopping for a refinance. The goal will be to secure a lower interest rate than your modified rate, eliminate any of the less desirable features of your modification, like a balloon payment or a variable rate component, and get into a simple, predictable loan that puts you back on a standard financial footing. Now, for the second huge question: can you sell your house if it has a modified loan? What if a new job requires you to move? Or you decide you just want a fresh start somewhere else? This is a point of major anxiety for many, who fear the modification has chained them to their property forever. Let me be perfectly clear. You can absolutely sell your home at any time after a loan modification. The modification does not lock you into the house. The process of selling is, for the most part, exactly the same as it would be for any other homeowner. You hire a real estate agent, list the property, negotiate with the buyer, and go to closing. The critical difference, and this is the part you must understand, is how the payoff amount is calculated at closing. This is where things like principal forbearance or deferred principal come roaring back into the picture. Let's use a simple, clear example. Imagine your original mortgage balance was $400,000. During the modification, to get your payment down, your lender agreed to a principal forbearance of $80,000. This means they took $80,000 of your principal, set it aside, and recalculated your monthly payments based on a new lower balance of $320,000. You're not paying interest on that $80,000, and you're not making monthly payments on it. It's just sitting there waiting. It waits until the loan matures or until you sell the house. So, let's say a few years later you sell your home for $500,000. At the closing table, you don't just owe the remaining balance on the $320,000. You owe the remaining balance on the $320,000 plus the entire, untouched $80,000 of deferred principal. That entire amount becomes due in full from the proceeds of the sale. So, out of your $500,000 sale price, you'd first pay off that total mortgage balance. Let's say it's around $390,000 by then when you combine the two parts. Then you pay closing costs and real estate commissions. Whatever is left over is your profit, your equity. This is why it is non-negotiable that you know the exact terms of your modification. You need to know to the dollar how much principal was deferred. It's part of the total debt you owe on the house, even if you're not making monthly payments on it. Ignoring it can lead to a devastating surprise at closing, where you walk away with far less money than you expected, or worse. What's the worse? The nightmare scenario is if the housing market has gone down, and your sale price isn't enough to cover the full, combined mortgage balance. If you sell for, say, $380,000, but your total payoff including the deferred principal is $390,000, you're underwater. This situation is called a short sale. A short sale is when the bank agrees to let you sell the house for less than what you owe and potentially forgive the difference. It's a complex process that requires the lender's explicit approval for any offer you receive, and it has its own set of consequences for your credit. It's a viable option, but it's a completely different path than a standard sale. So the takeaway is this: a modification is a tool for affordability and stability right now. It is not a permanent state. It is a bridge to a time when your financial situation has improved, your credit is repaired, and you can either refinance into a better loan or sell the property on your own terms, with full knowledge of your obligations. Living with a modified loan requires a new level of financial discipline. It's about more than just making the new lower payment. It's about seizing the second chance you've been given. It means creating a budget and sticking to it, building an emergency fund so the next unexpected car repair doesn't become a crisis, and diligently monitoring your credit. This proactive approach is what transforms a loan modification from a temporary patch into a permanent foundation for your financial recovery. It's what gives you back the power to choose your next move, whether it's refinancing or selling. But what happens if this bridge isn't available to you? What if, after all the paperwork and all the waiting, your application for a loan modification is denied? Or what if you look at the terms they offer and realize it just won't work for your family? It can feel like you've hit a brick wall, like you're out of options. But you're not. The denial of a modification is not the end of the story. There are other powerful tools and strategies available to homeowners in distress. The first step is to understand why you were denied. Your lender is required by law to send you a denial notice that explains the specific reason. Don't just accept a vague answer over the phone. Get it in writing. Was your income too low? Was it too high? Did you fail the net present value or NPV test, which is basically the bank's calculation of whether they'd make more money modifying your loan or foreclosing? Was a document missing? The reason for the denial is your roadmap. In many cases, you have the right to appeal the decision. This isn't just asking them to please reconsider. An appeal is a formal process where you can address the specific reason for denial. If they said your income was too low, you can provide new documentation showing a recent raise, a second job, or contributions from other household members. If they made a calculation error, you can point it out with your own evidence. The key is to be specific, professional, and provide documentation to back up your claims. Think of it less like a plea for mercy and more like presenting a case in court. You are correcting the record. But what if an appeal isn't an option, or it also gets denied? Let's talk about other loss mitigation options. These are alternatives your servicer might offer to avoid foreclosure. Two of the most common are a forbearance plan and a repayment plan. They sound similar, but they are critically different. A forbearance is a temporary pause or reduction of your mortgage payments. This is designed for short-term hardships. Maybe you lost your job and you just started a new one, but you need a couple of months to get your first paychecks. Or perhaps you had a sudden large medical bill that wiped out your savings. A forbearance gives you breathing room. But, and this is a huge but, those missed payments don't just disappear. At the end of the forbearance period, you have to pay them back. This could be in a lump sum, which is often impossible, or it could be added to your loan balance or paid back over a set period. You need to be crystal clear on how the payback is structured before you agree to anything. A repayment plan is a little different. This is for homeowners who have fallen behind, but can now afford their regular mortgage payment, plus an extra amount each month to catch up on the past due balance. For example, if you miss 3 payments of $2,000, you're $6,000 behind. The bank might agree to a repayment plan where you pay your regular $2,000 plus an extra $500 a month for 12 months to clear that debt. This only works if your income can support that higher payment. It's a way to get current over time without changing the original terms of your loan. Both forbearance and repayment plans are temporary fixes. They don't solve a long-term affordability problem. If your hardship is permanent, if your income has been permanently reduced and you can no longer afford the original payment, then these options just delay the inevitable. This brings us to a more difficult conversation. What happens when it becomes clear that you cannot afford to stay in the home, even with a modification? In this situation, the goal shifts from saving the home to exiting gracefully and minimizing the financial damage. Two primary options here are a short sale and a deed in lieu of foreclosure. A short sale is when the lender agrees to let you sell your home for less than the total amount you owe on the mortgage. Let's say you owe $300,000, but due to market conditions, your home is now only worth $250,000. With a short sale, the bank agrees to accept that $250,000 from a buyer as full payment, forgiving the remaining $50,000 shortfall. This sounds great, but it's a complex and lengthy process. You have to find a buyer, and the bank has to approve the offer, which can take months. It's a lot of work and uncertainty. The most important question to ask in a short sale is about the deficiency. That $50,000 shortfall is called a deficiency. You need to get it in writing that the lender is waiving their right to pursue you for that deficiency. If they don't, they could potentially sue you for that $50,000 later on. This is called a deficiency judgment, and it's a devastating blow after you've already lost your home. A deed in lieu of foreclosure is simpler. It's exactly what it sounds like. You voluntarily sign the deed to your property over to the lender. In exchange, the lender agrees to cancel your mortgage debt. You essentially hand them the keys and walk away. This is often faster and less complicated than a short sale. But again, the issue of the deficiency is paramount. You must ensure the agreement explicitly states that the debt is fully satisfied, and that the lender waives any right to a deficiency judgment. A deed in lieu is generally not an option if you have other liens on the property, like a second mortgage or a home equity line of credit, because the primary lender would have to take on those debts. Both a short sale and a deed in lieu will damage your credit, but the impact is generally less severe, and you can typically recover faster than if you go through a full foreclosure. They offer a measure of control and dignity in a situation that can feel completely out of your control. Now, we need to talk about the final, most powerful tool a homeowner has when facing foreclosure bankruptcy. I know the word itself is scary. It's associated with failure and financial ruin, but I want you to reframe how you think about it. For a homeowner, a Chapter 13 bankruptcy isn't an ending. It is a legal, court-supervised reorganization. It is one of the most powerful consumer protection laws on the books. When you file for Chapter 13 bankruptcy, something called the automatic stay immediately goes into effect. This is a legal injunction that instantly stops all collection activities. It stops the harassing phone calls. It stops the threatening letters. And most importantly, it stops a foreclosure sale, even if it's scheduled for the very next day. The automatic stay gives you immediate, powerful protection and forces your lender to stop and deal with you through the federal court system. Under Chapter 13, you propose a plan to repay some or all of your debts over a period of 3 to 5 years. For your mortgage, this is incredibly powerful. The plan allows you to take all the payments you've missed, the arrears, and spread them out over the life of the plan. So if you're $10,000 behind, you don't have to come up with it all at once. You can pay it back in small, manageable chunks over that 3 to 5 year period, all while you resume making your regular monthly mortgage payments. In essence, Chapter 13 forces the lender to accept a repayment plan under the supervision and protection of a federal judge. Furthermore, in some jurisdictions, the bankruptcy court offers a mortgage modification mediation program. This is a structured process where you and your lender are brought together with a neutral third-party mediator to try and negotiate a loan modification. It can be more effective than trying on your own because the lender is now accountable to the court. Filing for bankruptcy is a major decision with long-term consequences for your credit and finances. It is not a DIY project. You absolutely must consult with a qualified bankruptcy attorney to understand if it's the right path for you. But do not dismiss it out of fear. It is not a sign of failure. It is a strategic tool designed to give honest but unfortunate people a fresh start and a way to save their most important asset, their home. So let's bring this all together. From the moment you realize you're in trouble, to applying for a modification, to navigating a denial, and exploring every single alternative, the one constant is you. The journey is overwhelming, it's stressful, and it's emotionally draining. But knowledge is the antidote to fear. Understanding your rights and your options transforms you from a victim of circumstance into an active participant in your own future. You now know what a modification is and how it works. You know how to prepare a powerful application. You know what to do if you get denied. You understand forbearance, repayment plans, short sales, and the deed in lieu. And you understand the ultimate safety net of a Chapter 13 bankruptcy. Your home is more than just an asset. It's the center of your family's life. Fighting for it is one of the most important fights you'll ever have. The worst thing you can do is nothing. The worst thing you can do is let the letters pile up unopened, to let fear paralyze you. Your next step isn't to solve the entire problem today. Your next step is to take one small, informed action. Pick up the phone and call a nonprofit, HUD-approved housing counselor. Organize your financial documents. Schedule a consultation with a qualified attorney. Take the first step. You have options. You have rights. And now you have the knowledge to use them.